If you're tired of constantly chasing after the latest shiny object on the stock market, then let me tell you, there's a better way. As a diehard dividend investor, I've learned the power of patience and the freeing feeling of earning a passive paycheck from dividends without having to lift a finger. And today, I'm going to share with you 5 dividend stocks that I think are so great that they've earned a permanent spot in my portfolio. And unless something crazy happens and these companies just completely implode, I never plan on selling these stocks. I'm taking them to the grave. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow portfolios and collect that cash flow. Also, leave me a comment below and let me know which stocks in your portfolio do you plan on holding on to forever. I'd be curious to hear if we have any of the same ones. Anyway, guys, the first stock that I plan on holding on to forever is gonna be Apple. Now, first and foremost, as a consumer, I love this company. I pretty much got the whole collection. I'm looking at my MacBook right here. I've got my iMac over here. And obviously I'm rocking with an iPhone, and I also have an iPad here. And believe it or not, I still have an old iPod Classic as well that still works. 120 gigabytes on this bad boy. But as an investor, it makes it more fun to own shares of a company that I actually use, and I also think it helps me better understand the company. You see, Apple's secret sauce lies in their ability to make technology that doesn't feel like technology. All of their products are sleek, intuitive, and for the most part pretty easy to use, which is why I love using Apple products and have the whole collection. But it's not just about aesthetics. Apple has also created an ecosystem of products and services that work together seamlessly like a perfectly choreographed dance. If you want to text your friend from your MacBook, no problem at all. If you need to answer a call on your Apple Watch, you can do that too. It's like they read our minds and gave us exactly what we wanted before we even knew we wanted it. And speaking from experience, when it comes to brand loyalty, Apple fans are like a cult. There's no other way to say it. We Apple users will defend our iPhones to the death, and many will eagerly line up for the latest release like it's the second coming of the Messiah. That kind of devotion is hard to come by in the tech world, but Apple has managed to pull it off with flying colors. Now, moving on, one thing Apple is not known for is their impressive dividend stats. I mean, their forward yield is lacking pretty heavy, 0.61%, but I will say the rest of the stats are looking pretty good. They have an extremely low payout ratio of about 15.5 with a lot of room to keep growing this dividend. And they also have some nice consistency of doing exactly that. They have a 5-year growth rate near 8%, which is nice, and a 9-year dividend growth history. Now, as far as the stock goes, Apple is more known for outperforming the S&P 500, which it has. I mean, not here in the last year where they're down about 6.5%, but if we zoom out across a longer period of time, looking at the last 5 years, Apple has completely crushed the S&P 500 with a 270% gain. Furthermore, if we zoom out even farther across the last 10 years, we're seeing a 4-figure gain from Apple compared to the S&P 500's 216%. So as you can see, you really don't buy Apple for the dividend. The great majority of your returns are going to come from share price appreciation, and in my position, that's certainly been the case. Now, taking a look at my Apple position on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to it in the description of this video. I hope you check it out. But I haven't had this position for very long. I started buying it back in December, and at this point I have about 6.5 shares, and I bought it just the right time. My average cost is $129.45, which is quite a bit lower than the current share price, so I'm seeing a pretty nice gain. Getting more specific, my position, which I've only had, remember, for about 3 months now, is up nearly 20%, which is quite a big gain in such a short amount of time. And this stock ran up too quick in share price for me to establish a sizable position. I only have 2.37% of my portfolio in Apple right now, but I'd love to buy some more if there's a bit of a pullback in this company. Anyway, moving on, the second stock that I never plan on selling. I love this company. It's SnapOn, who is known for their high quality tools that are of the kind Tim the Tool Man dreams about. Their tools are made from premium materials and are designed to withstand heavy use and abuse, which makes them ideal for professional mechanics and serious DIY enthusiasts. And SnapOn tools also have a wide range of products that are designed to meet the needs of different industries and applications, from hand tools to power tools, diagnostic equipment to tool storage. SnapOn pretty much has it all. Having said that, because their tools are so high quality and heavily sought after, they tend to come with a premium price tag, and SnapOn offers financing options for customers who want to purchase them but don't have the funds to pay for them outright. Overall, what makes SnapOn tools so special is their combination of quality, precision, and versatility, and these factors have earned SnapOn a loyal following among professionals and enthusiasts alike. Now, moving on, SnapOn's dividend stats are going to be much more desirable than what we saw with Apple. Their yield is much higher, about 2.5%, and they also have a pretty low payout ratio, about 35%, with an extremely high 5-year growth rate, which is the shining star of their dividend stats, near 15% with a 13-year dividend growth history. Now, like Apple, SnapOn's also crushing the S&P 500 across all time periods. In the last year, they're up 25%, while the S&P was down 5.5%. If we zoom out across the last 5 years, they're beating the S&P by about 15%. And zooming out once more across the last 10 years, they are crushing the S&P 500 in this time period by about 56%. Now, as far as my position goes, I have about 9 shares of SnapOn at an average cost of about $211, which is quite a bit below the current share price, guys. And over here, this leaves me with a market return of about 17.7%, but if we take dividends into account, I'm up over 20% with my SnapOn position. Now, in regards to how it's allocated in my portfolio, I'd say SnapOn's kind of like a middle of the road position for me. I have about 5% of my portfolio in this company, and I'll tell you what, I would not mind adding more at some point. And now moving on to the third stock that I plan to hold on to forever, this one is gonna be Lowe's. And when it comes to home improvement retailers, they pretty much have a duopoly with Home Depot, which is a competitive advantage in itself. With two major players controlling the industry, it becomes more challenging for smaller companies to compete and gain a foothold in this home improvement retailing space. Now, taking a look at their dividend stats, they're looking pretty fantastic. Lowe's is most definitely a high growth dividend stock. Their yield's pretty average, 2%, but they have a very low payout ratio, sub 30%, which I really like to see. And look at that 5-year growth rate, guys, 20% across the last 5 years. And I actually think if we go over to this page right here, we can see that across the last 10 years, their growth rate's pretty much the same, 20% on average across the last 10 years. That's impressive. And lastly, looking at their dividend growth history, 59 straight years, which makes Lowe's a dividend king. Gotta love that. Now, not only is Lowe's a dividend king, but they've also crushed the S&P 500. Well, actually, not in the last year they haven't. They're down 9% while the S&P is down 5.5%. But zooming out across the last 5 year, guys, look at that. They have more than doubled the returns of the S&P 500 in the last 5 years. And furthermore, zooming out across the last 10 years, look at that. Once again, they have more than doubled the return of the S&P 500 in this time period. That's crazy. Now, taking a quick look at my position, I have 12.3 shares of Lowe's at an average cost just under $200 per share. And guys, it was very close to my average cost per share very recently, but it started to trickle back up and it's now just above 200 again. But with that, my position is up about 4%, and I'm actually going to start buying a little bit more of this company right now while it's so close to my average cost. In fact, guys, while we are on the subject, I'm actually going to buy some Lowe's right now. All right, there we go. $180 invested into Lowe's. Got almost 1 share there, so that's pretty nice. But anyway, as far as my position goes, Lowe's is one of the bigger positions in my portfolio, nearly 6% of my entire portfolio. And I think this makes it the 4th biggest stock in my portfolio right now, which I'm very happy with. I love having this as one of my core positions. And now moving on to the 4th stock, guys, this is one of my favorite companies of all time, Procter Gamble, which has a portfolio of some of the world's most recognizable household brands. I mean, we're talking Tide laundry detergent, we've got Dawn dish soap, we've got Crest toothpaste, and all of these other highly recognizable brands. Another thing that sets Procter Gamble apart is their global reach. They operate in over 180 countries and have a deep understanding of cultural differences and preferences, which allows them to tailor their products and marketing strategies to specific regions and demographics and gives them a competitive edge over other companies that may take a one-size-fits-all approach. Now, as far as their dividend stats go, everything is looking pretty average, mid 2% yield, kind of highish payout ratio, average growth rate. But look at that dividend growth history, 66 straight years. Procter & Gamble is like the king of dividend kings. Now, out of all the companies we're talking about today, Procter & Gamble is the worst performer. In the last year, they have not beaten the S&P 500. It's pretty close, but S&P has a little bit of an edge. Now, across the last 5 years, Procter & Gamble actually has beat the S&P up over 100%. However, if we zoom out across a longer period of time, across the last 10 years, Procter & Gamble does lose to the S&P 500, which isn't ideal, but just considering the products that Procter & Gamble sells, as well as what we saw with their dividend stats, this company is about as reliable as it gets. And that's why I have it as one of the biggest positions in my portfolio. I currently have just over 26 shares of Procter & Gamble, and right now it's looking pretty close to my average cost per share. I'm up less than 1% with Procter & Gamble, but about 3.5% if we take dividends into account, so this is one I will probably be adding to as the weeks go on. And like I said, Procter & Gamble is one of the biggest positions in my portfolio. It currently makes up about 8.5% of my total portfolio, and it's only second compared to Starbucks here, who is 9.3%. And that brings us to the last stock of the day. This last one I will never sell is Starbucks, who has built a brand that's practically synonymous with coffee. I mean, frankly, guys, when you think of coffee, you think of Starbucks. Their iconic green and white logo is instantly recognizable, and their stores are practically everywhere. Over the years, they built a loyal following of coffee addicts who are, believe it or not, willing to pay a premium for their cold brew and pumpkin spice lattes, and I'll tell you what, I'm certainly no exception to that. But it's not just the coffee and the brand that sets Starbucks apart, it's really the entire experience. The cozy atmosphere, the smell of freshly brewed coffee, it's all designed to make you feel like you're part of something more than just getting a cup of coffee. Essentially, Starbucks has turned the act of getting coffee into a ritual, and people love it. With that said, this company's biggest competitive advantage is their ability to innovate and adapt. Whether that means introducing new products like their recently announced Oleato, or investing in technology like their mobile app and rewards program, which is a huge hit, Starbucks is constantly evolving to meet the changing needs and tastes of their customers. And their dividend stats aren't too shabby either, guys. Their yield is on the lower end, about 2%, with a higher payout ratio near 70%, but it's pretty normal for this company. And in the growth department, things are looking great. A nice double-digit 5-year growth rate with 12 years of consecutive dividend growth. Now, compared to the S&P 500, Starbucks has just dominated across all time periods. In the last year, they're up 27% 87% while the S&P was down. Zooming out across the last 5 years, they're up 3 figures, over 100%, while the S&P was up just above 60%. And then zooming out once more across the last 10 years, they beat the S&P by nearly 120%. That's pretty nice. And like we saw a moment ago, Starbucks is my portfolio's biggest position, making up 9.3% of my total portfolio. And currently I have about 38.5 shares of this company at an average cost just under $90 per share. So my position is doing pretty good right now. And this leaves me with a share price gain of about 16.6%. But if we take dividends into account, I'm up closer to 20%. So looking good, Starbucks. Anyway, those were the stocks that I never plan on selling. And if you want to hear about a handful of other ones that I most definitely will never ever buy and suggest you do the same, then check out this next video right over here. In this one, you'll learn about 3 pretty popular dividend stocks that many people love to buy for their high yields and monthly dividends, but truth be told, they're not great investments and you should avoid them at all costs. So click right over here to check them out, and I'll see you in the next one.